The last time margin debt exploded, public mania took over, and everyone believed the market could only rise. It ended with the worst crash in modern history. Today, those same forces are building again, only faster and on a much bigger scale. The charts look familiar, the behavior looks familiar, and the pressure under the surface is already shifting in dangerous ways. If this script is really returning, the only question left is how close we are to the next Monday that changes everything. The 1929 collapse did not begin with chaos. It began with small signals that people brushed aside, signals that slowly built into a pattern strong enough to break the market once the pressure became too much for the system to handle anymore. That same pattern is forming again today, not in dramatic ways, but in the calm rise of risk, leverage, and confidence, creating a setup that feels stable on the surface while growing weaker underneath with each passing week. Margin sits at the center of both stories, acting like the spark that turns a normal market into one that can rapidly overheat, pulling people into positions they never should have taken with borrowed money they barely understand. In the 1920s, easy borrowing pulled regular workers into risky bets they believed were safe, because everything around them seemed to rise without effort, convincing them that using credit was the smartest move they could make. Today's market is no different, with margin debt rising to levels that look almost unreal, reflecting a confidence that ignores how fragile leveraged positions become when the smallest drop can force people to sell at the worst moment. Leverage makes gains appear larger than they truly are, feeding the belief that winning is simple, all while hiding how dangerous the setup becomes once losses start to appear, and the borrowed money works against the investor instead of helping them. Most people never notice leverage turning into a problem because everything feels fine until it suddenly isn't, and by the time the cracks show, the damage is already threaded deep into the system, waiting for one sharp hit to break it. Investors in the 1920s believed they were in control, convinced their strategies were smart, and their timing was steady, not realizing their confidence was based on rising prices, not real strength or an understanding of the risks they carried. Today's traders mirror that same belief, using modern platforms that make everything fast and simple, making it easy to assume they have more skill than they truly do, while ignoring the weight of risk building under the surface. Large financial firms in 1929 relied on heavy leverage too, stacking risk upon risk, because high returns made it look like nothing could go wrong, even though the foundation holding everything together was far weaker than they understood. Modern corporations repeat the same pattern through massive debt loads that climbed during years of cheap money, creating a situation where many companies now carry obligations that only work as long as the economic environment stays perfectly supportive. Leverage creates a weak foundation no matter how strong things appear from the outside, turning a rising market into something that can fall apart quickly once selling pressure appears, and lenders start pulling back support. Rising asset prices distort reality, convincing people that risk has disappeared, leading them to double down on positions they do not fully understand, believing the trend itself will protect them from anything unexpected. As leverage spreads, it becomes part of the system's normal behavior, hiding in millions of small decisions that slowly build into something that can break with surprising speed once confidence begins to slide. In the 1920s, newspapers filled their pages with praise for endless growth, feeding the belief that the strong market was permanent, pushing more people to buy stocks because they felt left behind by the excitement. Today's headlines mirror that same tone, celebrating every rise, every record, and every surge, making it harder for anyone to question whether the market's strength comes from real value or simply from borrowed money and growing optimism. This constant excitement creates mania, the second force in the script, a force shaped by crowds who copy each other, not because they understand the market, but because they fear missing out on what everyone else appears to enjoy. Everyday people in 1929 rushed into the market because they saw neighbors, co-workers, and even strangers making money, believing they deserved a piece of the fast-paced growth happening around them. Millions of new traders today act the same way, jumping into markets with very little experience, encouraged by stories of easy gains that spread through videos, posts, and conversations that build confidence far faster than caution. Modern tools make trading so easy that anyone can participate, turning the market into a place where speed often matters more than understanding, creating conditions where risk builds quietly while the excitement feels completely harmless. Social media supercharges today's excitement, pushing trends to millions instantly, amplifying both confidence and fear, while making speculation feel like a normal part of life instead of a dangerous attempt to chase short-term gains. Expert voices in the 1920s pushed the idea that growth would never slow, convincing people that any dip was a chance to buy more, which kept the mania alive long after rational thinking should have returned. Modern analysts often push the same message, calling every pullback a temporary shake, encouraging people to treat risky behavior as normal, reinforcing the belief that markets are too strong to break. As this mindset spreads, people copy each other without much thought, repeating the same moves and ignoring the risks hiding behind the excitement, creating a cycle that only grows stronger the more people join in. The crowd effect builds a false sense of safety, convincing everyone that nothing bad can happen when so many people are participating, even though this exact belief is what makes a system fragile enough to fall apart with surprising speed. Mania grows strongest when prices climb for long stretches, creating a feeling that the rise is normal, pulling more people into the market and making them believe the momentum itself will protect them from anything that might disrupt the trend. In the 1920s, early warnings appeared, but were ignored because profits felt easier than ever, encouraging investors to believe they understood the market even when the cracks were starting to spread beneath the surface. Today, warnings from analysts, economists, and insiders are often pushed aside in the same way, dismissed as negativity, while the excitement of rising prices drowns out any message that suggests the risk is growing faster than the gains. As the excitement intensifies, the system actually becomes weaker because more borrowed money enters the market, more investors crowd into the same trades, and the entire structure becomes sensitive to any sudden change in direction. Even small dips can trigger big reactions when margin is stretched, because drops force investors to cover losses, and covering losses often means selling at the worst moment, which spreads the pressure through the market with surprising speed. In 1929, the market showed early signs of strain through sudden shakes that made a few people nervous, but most ignored them, believing every drop was temporary, as long as the overall trend still pointed upward. Today's sudden swings reflect that same pattern. Sharp moves that appear out of nowhere, reminding anyone paying attention that the calm on the surface is hiding deeper instability waiting for the right trigger to break loose. Each swing exposes a little more of the pressure underneath, showing how fragile the structure becomes when too many players depend on borrowed money, fast trades, and the expectation that prices will always return to their highs. In the late 1920s, liquidity quietly thinned out as lenders became cautious, creating an environment where buyers were suddenly harder to find and sellers were forced to accept lower prices than they expected. Liquidity today depends heavily on confidence rather than fundamentals, meaning the moment confidence weakens, the flow of money can shrink quickly, leaving investors exposed with no easy way to exit positions they believed were safe. When leverage dominates a market, investors can feel trapped because losses grow faster than expected, forcing them into decisions that spread selling pressure across the entire system, whether they want to participate or not. In 1929, margin calls triggered widespread panic, creating a chain reaction where selling forced more selling until the market could no longer support the pressure building inside the system. Today's automated trading systems amplify this process because once losses reach a certain point, algorithms begin liquidating positions without hesitation, creating waves of selling that grow larger with each automated move. Technology can stabilize markets on calm days, but during stress, it can accelerate a meltdown because speed replaces thought, and sudden waves of selling can overwhelm buyers before they even understand what caused the drop. In the 1920s, investors believed the worst moments had already passed whenever the market bounced, convinced that any decline was just a normal part of growth, even though the underlying damage was still spreading. Today's belief that modern tools, advanced models, and fast platforms can prevent a crash repeats that same misplaced confidence, creating a mindset where people trust the system simply because it has not broken yet. Markets tend to fall hardest when confidence is strongest, because the crowd becomes fully invested and no one prepares for trouble, leaving almost no safety net when pressure finally flips into fear. Leverage becomes truly dangerous when most investors are already committed, because once selling starts, there are fewer people left to step in and hold prices up, allowing fear to move through the market unchecked. In the 1920s, corporate debt stacked up behind the scenes, creating added pressure on companies that depended on steady revenue to meet their obligations, even though their balance sheets looked fine on the surface. Today's companies face even larger debt loads, many taken on during years of cheap borrowing, and those obligations are now becoming harder to manage as rates rise and financial conditions tighten. When credit tightens, the entire economy feels the pressure because companies, lenders, and investors rely on easy access to money, and when that access slows, the effects spread through every part of the financial system. The Federal Reserve in 1929 faced a difficult choice between fighting inflation and controlling speculation, a conflict that left them moving cautiously while the market continued to build more risk than they could manage. Today's central bankers face similar pressure, trying to balance inflation concerns with an over-leveraged market, knowing that any move in the wrong direction could tighten conditions too fast and expose weaknesses hiding beneath the surface. Markets react sharply when policy becomes uncertain, because investors depend heavily on stable expectations, and even small changes in messaging can shift sentiment quickly enough to create real pressure across stocks, bonds, and corporate debt. In the 1920s, optimism about endless prosperity blinded people to the warning signs, and that same belief exists today as technology, innovation, and recent profits convince many that a major breakdown is impossible. Optimism in the 1920s grew so strong that people stopped questioning whether the economy had limits, and today's belief that technology can solve every problem repeats that same pattern, hiding the structural weaknesses sitting underneath the excitement. Optimism often masks the real issues because rising values make people feel safe even when the foundation is weakening, creating a dangerous environment where confidence grows louder while the system quietly becomes more fragile with each passing month. Warning signs in 1929 appeared slowly through failed loans, shaky companies, and strange price movements. But these signals were overlooked because the market seemed unstoppable, and people convinced themselves the strength they saw was permanent. Today, subtle stress signals appear across multiple sectors, from shaky real estate markets to falling liquidity, creating a picture that looks calm from far away but reveals instability when examined closely, especially by those watching borrowing patterns. Rising interest rates in the late 1920s put real pressure on borrowers who depended on cheap credit, pushing them toward breaking points they never expected as the cost of maintaining their debts climbed higher. Modern borrowers feel similar pressure as higher payments hit homeowners, companies, and traders, creating a slow tightening that reduces spending power and stretches balance sheets in ways that weaken the broader system. Small cracks often grow into larger risks because each new weakness places more stress on the surrounding system, and when enough small problems stack together, they form a dangerous chain that can break under even mild pressure. Every era reaches a breaking point, a moment when the buildup becomes too heavy for the financial structure to support, and that moment arrives not through panic alone, but through the quiet weight of all the decisions leading up to it. In the 1920s, the breaking point formed quietly as businesses struggled with debt, banks tightened credit, and investors ignored signs of trouble, creating a situation that felt stable right up until it stopped working. Today's cracks appear in real estate strains, corporate earnings warnings, weak credit markets, and slower consumer spending, creating a similar environment where everything seems fine until several stress points line up at the same time. Investors often ignore risks when profits feel easy because comfort hides consequences, leading people to overlook how much danger they carry, simply because the market has rewarded their confidence for a long stretch. Fear rarely shows itself early in the cycle, because rising prices convince everyone that the trend will continue, and this calm becomes a trap when the pressure finally breaks and confidence disappears faster than anyone expects. Markets during mania run mostly on faith, not logic, because people trust momentum more than fundamentals, and once that trust weakens, price movements can flip from steady gains to violent drops in a short amount of time. Faith collapsed in 1929, during a single Monday, when selling pressure overwhelmed the system, turning confidence into panic within hours and creating a moment that still stands as one of the most dramatic shifts in market history. Today's sentiment can shift even faster because information moves instantly and automated systems respond without hesitation, meaning a wave of fear can spread in minutes, not hours, triggering a rapid reversal that catches investors off guard. Selling pressure feeds on itself because each drop forces more selling, and once leveraged investors begin to exit, the process can expand quickly as more positions become unstable and require liquidation to cover the losses. Forced selling spreads through the market like a chain reaction, pushing prices lower and triggering more margin calls, creating a loop that grows stronger as the number of investors trying to reduce exposure increases. In 1929, margin calls hit so hard that entire portfolios were wiped out, leaving investors unable to meet their obligations, which created even more selling pressure when lenders demanded immediate repayment. Today's algorithms can trigger forced selling automatically, amplifying the effect because machines execute trades faster than humans can react, turning a small decline into a sharp drop as systems work through preset instructions. When too many people try to exit at once, the system cannot handle the volume, and prices fall faster than buyers can step in, revealing how fragile the structure becomes during moments of collective fear. The panic in 1929 started with a small spark, a subtle shift in sentiment that became a rush for the exits, proving how easily a calm market can flip into a dangerous spiral when confidence breaks. Modern markets face similar risks because small triggers can cause large reactions, especially when investors rely on fast trading, complex products, and borrowed money that leaves them exposed to even minor disruptions. Liquidity disappears quickly during panic because buyers step back, waiting for clarity, while sellers crowd the market, creating an imbalance that speeds up the drop and makes recovery harder to achieve. In 1929, banks struggled to keep money flowing because withdrawals surged and credit tightened, weakening the system even more as financial institutions halted lending and fought to protect their reserves. Modern liquidity relies heavily on digital systems that can freeze or overload during stress, meaning even a short disruption could create a large ripple across markets that depend on constant access to fast-moving capital. Markets today can fall faster than anything seen in the past because modern trading moves at a speed that leaves little time for reflection, turning a normal dip into a rapid slide if confidence weakens even slightly. Confidence acts as the glue holding everything together, and when people trust the system, prices stay balanced. But when that trust weakens, the entire structure becomes unstable, as fear moves faster than any information source can calm it. In 1929, confidence vanished within hours as selling pressure overwhelmed hope, and once that shift happened, no amount of positive messaging could slow the downward momentum that swept through the market. Today's investor confidence is just as fragile because many rely on surface-level signals, assuming strength because prices rise, even though those same prices depend on a delicate balance between borrowed money, automated trading, and public enthusiasm. The three forces, margin, mania, and a bad Monday, always interact in a predictable way because each one supports the next, creating a cycle that appears unstoppable until the final piece snaps under pressure. Margin creates the fuel by expanding risk, allowing investors to take positions far larger than their cash would normally allow, which increases the sensitivity of the market to any movement in the wrong direction. Mania transforms that fuel into a powerful force as crowds rush in, believing the rising trend confirms their decisions, turning speculation into a widespread habit that feeds on the excitement of easy gains. Panic is the final trigger, the moment when confidence collapses and the same crowd that once pushed prices upward withdraws all support, leaving the market exposed to rapid selling and widespread loss. Margin debt today sits near record levels, showing how many investors rely on borrowed money to chase returns, creating the same fragile setup that made the 1920s market crack when pressure intensified. Retail speculation continues to rise, as millions of new traders push into the market through apps that make investing feel casual, even though many participants carry far more risk than they understand. This repeated cycle of excitement forms the modern version of mania, where profits shared online encourage more people to join, building a feedback loop that strengthens the trend while weakening the structure beneath it. Corporate debt adds another layer of risk because many companies borrowed heavily during years of low rates and now face higher costs that strain balance sheets, creating a hidden threat that resembles the pressure seen before the 1929 collapse. All three forces are tightening at the same time, borrowing, excitement, and vulnerability rising together, forming a setup that feels strong from a distance but reveals increasing instability when examined closely. Even when prices climb, the underlying system can weaken because gains built on leverage do not reflect real strength, and any shift in sentiment can expose how quickly those leverage positions can unravel. Pressure builds quietly as margin expands, confidence rises, and investors take bigger risks, creating a slow-moving weight that sits beneath the market until the right drop causes the entire structure to move at once. Investors often ignore all of these risks when times feel good because steady gains create comfort, and comfort encourages people to dismiss anything that contradicts the belief that the market will keep rewarding them. History shows that this pattern has never stopped repeating, no matter how advanced the tools become, because human behavior continues to follow the same path of confidence, excitement, and eventual fear. Every generation believes its moment is different, convinced that new technologies, new systems, or new ways of investing make breakdowns impossible, even though the mechanics of risk remain the same as they were a century ago. Markets consistently punish that belief, revealing that confidence built on hope, momentum, or borrowed money can collapse quickly, catching both new and experienced investors in the same wave of losses. A single bad Monday has the power to reset everything because once fear spreads, the market shifts from growth to survival, and people rush to protect what they have left, even if it means accepting painful losses. Today's environment contains all the conditions for such a day, with high leverage, intense speculation, and fragile confidence creating a setup that could flip rapidly if one unexpected shock hits the system. Early signs already show rising stress through volatility spikes, tightening credit, and unpredictable reactions to policy changes, each hinting at a system becoming increasingly sensitive to even small disruptions. The final break rarely comes from a dramatic event, but from the moment confidence slips and investors begin doubting stability, creating a wave of hesitation that quickly turns into widespread selling. Today's markets depend heavily on trust in institutions, technology, and liquidity, and if that trust weakens, the system can shift from calm to unstable far faster than most people expect. The script of margin, mania, and a bad Monday is not history repeating word for word, but history returning in a modern form, reminding us that the forces that broke the market once before are rising again in real time.